Hi, and welcome to the 2020 Economic Depression and Preparation Channel. I'm your host, Tony. Thank you for joining me once again on this weekend edition, January 24th, 2021. Please be sure to hit that subscribe button if you haven't already to get the latest, pure, unadulterated, unfiltered financial news in the U.S. and sometimes beyond the U.S. Today, I want to briefly talk about the housing collapse and how it may all play out. As you know, the real estate market is allegedly experiencing a boom due to these historically low mortgage rates that have been quite low for quite some time, uh, probably upwards of 12 or 13 years now. And now the mortgage rates are hovering somewhere between 2.75 and 2.8% for the 30-year mortgage out there. And that the 30-year bond rates have come up above 1%. There has been an increased demand for refinance of mortgages, as well as the demand for single-family homes or townhouses or condominiums in these urban high-density places have been, demands for builders have gone up. But there's a caveat in this. As you know, what goes up must come down, and these unsustainable prices for the starter homes, single-family homes, starter homes, and starter townhouses and condominiums are only going to increase. But sooner or later, this bubble is going to pop because it's unsustainable. Now, maybe in the higher-end homes and the higher-end home builders, etc., in that range, and people who are flipping homes and all that, maybe things is going to be all right. But according to reports, the spike in lumber and land prices causes home builder confidence to fall from epic high. Builder confidence in the market for single-family homes fell 3 points in January to 83, according to the Wells Fargo Housing Market Index. Anything above 50 is considered positive, noted the report, but it did fall 3 points in January to end this month. Of the index 3 components, current sales dropped 2 points to 90. Current sale conditions also dropped 2 points. Sales expectations in the next 6 months fell 2 points to 83, and buyer traffic, get this, from millennials to Gen X to baby boomers, fell 5 points to 68. So it looks like this current boom in housing is just a reflection of, to tell you the truth, a lot of the rich folks have been moving, super rich folks have been moving from states, high tax states like California, Illinois, New York, Massachusetts, and they're moving down into the Sun Belt states of Florida, Arizona, Texas, and places where, in Georgia, and places where they can get more bang for the buck at less taxes. Because remember, those states have no state income taxes, and the property taxes are somewhat lower, even though in Florida, property taxes are insurance. That's kind of offset by the insurance requirements because of the hurricanes, if you're going to talk about building on the coast and all that kind of stuff. But anyway, I digress. The main thing is that the builders are grappling with supply side constraints related to lumber and other material costs. They used to be able to buy all this in wholesale, which they do buy in wholesale and bulk, and builders were used to be able to get lumber and things of those natures at discount prices. But now there is material costs have gone up, and now with the increase in gas prices to transport these materials trans-country, across the country, or interstate, and the gas price is going to be going up starting the end of next month for most locales. Some locales have already are going to experience it earlier, obviously, like California with Arco and all their gas companies. But everywhere nationwide is going to experience gas prices going up after February into March, as even though OPEC and Saudi Arabia has agreed to limit production down to 1 million barrels a day, it's not going to matter. Gas prices will continue to rise into summertime. But material costs have gone up. There's a lack of affordable lots or parcels out there right now, and the labor shortages due to this health crisis, remember the workers that they need, the contractors, etc., that needed on site, is delaying delivery times and putting upward pressure on home prices, says Chairman Chuck Falk, a home builder in Tampa, Florida. Now, of the three components that we see here, we see that once the labor and the raw materials are going up, right? Not only that, but they're having a labor. Let's say we believe the media reports, instead of having a labor shortage, that means that they're going to have to pay the workers, the contractors that are on site, even more money for doing more work. So that's just totally unsustainable. Now, in 2021, mortgage rates will begin an upward climb, according to some economists. This is the lowest that it's going to get. It's this 2.5 to 2.8 range. And mortgage rates will eventually rise in response to the supply side being shorted out, and less parcels of land available for permitting, whether it be a single family homes or condominiums, townhomes, PUDs, manufactured homes, you name it. So while housing continues to lead this fake recovery forward, limited inventory is constraining more robust growth, according to most of the experts. So a shortage of buildable lots is making it difficult to meet strong demand, and rising material prices are far outpacing increases in home prices, which in turn is harming housing affordability. And this is the key right here. Housing affordability. How many people in America with an average median income is what, 50 or 60,000, can afford homes? The average starting price of a single family home in the United States is $340,000 and climbing. For a new one, I know, of course, used one, it could be less than that, but in some areas it could be less. But still, who can afford that, even with mortgage rates down like this? Who can afford that when they have other bills, utilities, car payments, kids payments, student loan payments, credit card payments, insurances, all kind of insurances and fees, you name it. So that's going to be more the major problem. And this is why this housing bubble is going to be so dangerous when it collapses, because you're going to have people upside down. It's not going to be a buyer's market, because no one's going to have the cash. The liquidity crisis is going to move from the banks. The banks are going to tighten up these loan applications, whether it's FHA or conventional or USDA or VA or any of these loans that you need to get, or doctor's loans or whatever loan you use to get a house nowadays. They're going to tighten up the credit of that. And also they're going to tighten up the rates. And so while the Federal Reserve Bank is anticipating to keep interest rates near zero, basically they have to until 2023, 2024, mortgage rates will continue to climb now, because the builders and everybody else, they can't make money on these properties at these rates, and the bank can't make money at properties at these rates. As the economy and more people lose their jobs, they're not going to be able to afford these homes, and so they have a lot of houses on the books right now. The banks have that are pre-foreclosure, foreclosure, short sales. They're on the books, and they're not going to be able to unload this stuff as they did in 2008 in the subprime market, because they can't do that no more, because of all the Glass-Steagall Act and all these different acts that they passed during the Obama administration. So what's going to happen is they're going to have a bunch of houses on the books, so they're pulling back inventory now, anticipation of the collapse, which we know is coming in the third or fourth quarter of this year, 2021, the housing collapse. And rental prices are going to be okay, because they know that a lot of people that have just sold their house are either getting into a rental situation to save money, or possibly, they're into retirement. A lot of baby boomers are downsizing, so they got to have more money to enjoy their upcoming retirement. And so this is very concerning. So keep your paper dry. Keep your paper dry, because we may be heading into a deflationary spiral very soon here in the fourth quarter of this year, with a lot of people unemployed, and a lot of these builders begging people and cutting their prices, these absorbent prices, to get people to move into these houses and condominiums and townhomes, because there's going to be less jobs, more demand, less cash out there in the system, despite all this stimulus money. And the housing correction is going to be absolutely brutal. And it's not going to be a housing correction that's going to last 1 year. This housing correction is going to last 10 to 12 to 15 years, because of the overvalued assets that they've created here in the system. So get prepared, stay vigilant, continue to prepare for food, water, medicine, hard, tangible assets, gold, silver, cryptos if you're into that, but don't put too much into that, because that also was not based on a realistic picture of this economy. So 10% here, 10% there, a little bit at a time wins the race. Every little bit helps. Every dollar you put away today for your generation helps another generation. And just remember that. Be blessed. I'll talk to you very soon. Thank you for joining me on the weekend edition of Preach to Me. Thank you.